In this video, I'm going to be talking about how we're about to start a recession. Everybody's out there telling us it's not going to happen. Right now, I'm looking for the S&P on the 60-minute chart to possibly form a triple bullish diversion. So if we take out this low and hit our 61.8 Fibonacci or 78.6 Fibonacci, maybe fill the CPI gap, I'm looking for a higher low or a lower low. Again, I was looking for a pullback, predicted it. We've got it. It may be done right here. I'm not certain. But that's what I'm looking for next week as we get the inflation data next week, as we get Powell's testimony before Congress. We're going to get President Trump possibly unveiling new tariffs. He said that Friday. The market did not like that. But he's also expected to unveil in greater detail the tax cuts. So the market may like that. We'll be watching to see how all this unfolds. Watch this video all the way through. Important stuff. That yes, I think we're going to get a pullback to test this low, a higher low or a lower low, maybe hit the 100 period in the trend line. Then I think we're going to resume the advance and go up and hit this red trend line from the July peak, forming a massive rising wedge. Recession indicators are flashing that we're about to have a recession. We will likely get one more final push higher, which will likely be around this trend line. Market will peak, and that will be followed by recession. Get up there, I think we'll have an inflation freak out. I think we'll start seeing the inflation data begin to turn up. Concerns about the tariffs, concerns about no Fed cuts. The market will drop 20%, and then the Fed will do an emergency cut and panic. That's what's going to happen. That's what always happens. Now, this low is a trend line from the 2023 low. We may test it again in our 100 period or get a higher low. We'll be watching to see how it unfolds. I've drawn in both scenarios here, but I do think this pullback that I predicted correctly and the bottom that I predicted correctly over here, I think that low is going to hold, and I think the pullback will give us a higher low. And that'll be followed by the grand finale, getting our final climax high to complete the blow off top. I predicted that we would bounce off of this trend line at the January low. We did. From our 2023 low, we could test it again, go a little bit lower, or even try to fill the gap and slightly violate it and then turn back up. But I think we're headed to this upper boundary of the rising wedge. This is the rising wedge on the daily chart. This is the upper boundary of the channel here in the weekly time frame, and this is where I think we're headed. I think we'll get some more volatility on into next week, and then maybe later in the week or shortly thereafter into next week maybe, we could see some kind of bottom develop and then resume the advance. Time is short. I'm going to show you absolute proof that we're about to have a recession, and the market, the S&P, will likely get this one final push higher, the final push higher, and then it's going to be followed by a push back to this trend line, which is going to be about 20%, and that's when we're going to get the rate cuts from the Fed. Support the channel with the link directly below. That allows me to be able to provide you this information. If you like the charts, you like the indicators, let me know that by supporting the channel today. If you could take a moment to partner with me, I would really appreciate it. I need to hear from you in order to make it work. I just share my charts with you every single day. The stuff I look at. If you like these charts, let me know that by supporting the channel. Most channels have sponsors. I turn those offers down. I don't want to sell you stuff. You're here to look at charts. I'm not to have me sell you something. So I just ask that you do what you can to help out, to support the channel. And I ask that rather than trying to sell you something. If you're new to the channel, I want to welcome you. My name is Ron. And we look at the technical analysis of the S&P 500, the NASDAQ, the Dow, and the Russell, and a few other things. I want to welcome you if you're new. Subscribe and follow along. NASDAQ, again, reversal bar. Now at the 10-period moving average, the 10 and 20 are support, and the 50 right in there. Again, if we pull back and get a triangle, if we form a triangle, look where these lows are pointing to the trend line right there. This is a trend line from the August low to the January low. Have a parallel boundary from the high right here to the high right here on the December top. If a triangle is forming, then again, this would be a very important level of support if that triangle does develop. If we break the trend line and we break the cloud, you've got your 100 period below that, you've got your gap filled down here at that 20,700 area. that is our CPI gap. So again, just some levels I'm looking at very closely. This trend line could expand and change if we come down here and find that. But if we get a bigger sell-off, again, that 20,227, the election gap fill from way over here. So just something worth paying attention to. The gaps, the trend line here, these lows right here for a possible triangle. And again, it's too early to tell if that's going to set up or not. But if we get a sell-off and then we just start drifting sideways a little bit more, then you got a shot at this triangle being a continuation and going higher. I've said I'm not so certain NASDAQ is going to make new highs. We got that topping tail in the monthly time frame. It hasn't been confirmed, but it's still a topping tail. So there's still risk of the NASDAQ having peaked. And we know that they diverge from time to time, and they certainly diverged with our peak on the S&P in January of 2022. NASDAQ did not make a new high. It had peaked back earlier in November of 2021. So just some support levels. Do we carve out a triangle? Do we take out this trend line and get a bigger sell-off? If we do we fill these gaps? Just looking at these levels very closely. Momentum is still bullish. If we get a bigger sell-off, we'll be looking at the momentum. And again, do we go to a new low or do we get another higher low here? And if we do get the higher low, you got a shot at a triangle. Or what could be a pennant, a continuation pattern. Chair Powell testifying 10 a.m. Eastern before Congress. The next day, we get the CPI data, which is expected to decline on a year-over-year basis. This could help the market. Again, I believe we're getting a pullback, either set up a higher low above the tariff sell-off low that we had on Monday. We can get a lower low, but again, the CPI year-over-year is expected on a year-over-year basis to come in at 2.8, lower than the 2.9% on a year-over-year basis, so expected to decline. The core is also expected to decline. This could be a positive for the market if this happens. Again, core 3.1 on a year-over-year was at 3.2. If it does decline, there might be a sigh of relief. Now, during that CPI release before the market opens, later that morning, Powell will give his second day of testimony before Congress, again, 10 a.m. Eastern Time. So again, he might remark on that CPI data. It does come in favorable, if it does come in on a year-over-year basis lower than the previous readings that we got. So again, this is something to be paying attention to. This will be Wednesday the 12th. Powell's testimony on Tuesday the 11th, and then Wednesday the 11th, and before Powell's second day of testimony, we get the CPI data. The very next day, we get the wholesale inflation data, the PPI, the Producer Price Index, and we'll get that on Thursday the 13th. So again, 2 days worth of inflation data. The market really focuses on that CPI, though. We had that previously, we had that increase in wholesale inflation, and then it declined back down. So again, we'll see how it comes in. Concerns that it eventually will spill over into the CPI data. But again, I talked about the CPI data at 2.9% now, and eventually, even if it goes down a little bit, eventually it's on its way higher. If we see it come in cooler than the previous month's reading, as I've been talking about, the 2.8 versus the 2.9, the 3.1 versus the 3.2. If it does come in lower, again, then that might be positive. But we'll be watching. Again, I do believe that we're pulling back. We'll see what happens. Powell the Hawk may show up on the first day of testimony, and the second day, it might be Powell the Dove. You just never know what you're going to get with him. Now, he has turned hawkish. Expect Powell to be asked about the tariffs. And again, that could create some volatility when he's asked about those tariffs. Because Powell believes that the tariffs are going to cause inflation. That's why when President Trump won the election, he got so concerned. And again, they started their rate-cutting campaign. Now they're second-guessing themselves, and that's likely going to cause them to have to do emergency cuts. They realize the recession that they're telling us isn't going to happen. Powell said that on December 18th, that it's clear we've avoided a recession. in the press conference, the recession happens that they're telling us isn't going to happen, then they're going to end up doing those emergency cuts. So just something to be watching going forward. Now, jobs report. I do want to say this. I had an issue with my microphone cord making the video. So yesterday on the Friday video, recently relocated my microphone, and I hope I fixed it, but I apologize if there were some snap, crackles, and pops in the video. I am going to fix that. If I can't fix it, then I'll just buy a new microphone cord. But I had made some adjustments to the positioning of the microphone, so it did that. I'm very, very sorry about that. But nevertheless, I went through some very important information in that video, and it's well worth the watch, even if the audio isn't perfect. Nevertheless, I digress. Talk about the jobs report. Oh, real fast. Friday the 14th, Valentine's Day. We're going to get the retail sales that day. Other things, too. We're going to get industrial production. Hey, that's predicting we're going to have a recession. We're going to get capacity utilization. That's predicting we're going to have a recession right now. Lots of things. Warning, we're going to have a recession. Also, after this week, we're going to have a short trading week. Next week, we'll have President's Day on the 17th after this week. So it'll be a short trading week the following week after this next week here. We have the unemployment report coming in. The Labor Department put out the jobs numbers. Came in lower than expected. Expected to be 169, came in 143,000. The previous month's reading was revised upward to 307,000. The unemployment rate ticked down to 4%. It was expected to come in at 4.1, and it was previously at 4.1%. We had the major revisions with the jobs report. You may recall back in August of 2024, we had the report that the economy had fewer jobs than first reported. We saw downward revisions out of the Labor Department data between the period of April 2023 and March of 2024, and that was reported last August. Now, getting revision updates here with this jobs report on past data. This has been reduced now, magically been reduced to just 589,000, which is better than the 818, but it still reflects an overestimating of jobs in that period between April of 2023 to March of 2024 by 589,000. Overestimated by that much, and I don't even believe that. These folks over at the Labor Department are putting out bogus numbers. I mean, it's clear. Anybody that pays attention to this stuff, constant revisions and the constant overestimating and then revising it down when nobody's looking, they're cooking the books. Okay, it's fake numbers that they're putting out and then changing them as they go along. They're either incompetent or they're doing it on purpose, and I believe they're doing it on purpose. So the numbers are untrustworthy. Being told how good the jobs report is, despite the downward revisions, well, the labor market is strong, and they had overestimated by 818,000, but now it's just 598,000. Oh, they've still overestimated by nearly 600,000 jobs between April of 2023 and March of 2024. Now, again, as the reports over the last 2 years have been put out, they overestimate on the amount of jobs being created on the first report and then quietly revise it down later. Now, some of the 2024 data is not yet complete revisions, and there will be other revisions. But with the incomplete numbers that we have, just in the last 24 months, the last 24 jobs reports during 2024 and 2023, we've had 17 of 24 months revised downward. 17 months out of the last 2 years, last 24 months, have been revised downward. They overestimated dramatically. So over here we have, again, 17 out of the last 24 months have now been revised downward. Over here we have the amount of the revisions, upward revisions, downward revisions. If you look at the last 2 years of revisions, up and down revisions, upward and downward revisions, with the jobs data, the original reading, from the original reading over here, if you look at the revisions that have taken place, they have greatly overestimated the amount of jobs. We're going to look at this right now. How many jobs did they actually overestimate in 2023 and 2024? In 2023 and 2024 combined, they revised downward 1,396,000 jobs. That means that they overestimated the amount of jobs created in 2023 and 2024 by revising down nearly 1,400,000. They revised upward 254,000, just 254,000. That's it. Greatly overestimating the amount of jobs created. So the final number is that they overestimated by 1,142,000 jobs in 2023 and 2024 combined. They overestimated by nearly 1,150,000 jobs overestimated in 2023 and 2024. That's how far off they are over at the Labor Department. And I don't even believe that. I think it's much worse. I think they're probably trying to put lipstick on a pig. I don't believe any numbers coming out of the Labor Department because, again, they're so bad. I've never seen anything like it in my life. And I've been looking at the economic data for years, and this is the worst I've ever seen it. Either they're purposely doing this or they're completely incompetent. I think they're purposely doing it. Now, out of the 1,142,000 jobs that were overestimated in 2023 and 2024, 712,000 of them came in 2024. In 2024, the Labor Department overestimated by 712,000 jobs. The rest of them came in 2023. In 2023, 430,000 jobs were overestimated. So imagine that. Surprise, surprise. Over 700,000 jobs overestimated right in time for the election, right before it. Who would have thought? You know, they say figures don't lie, but liars sure can figure. The majority of the jobs being overestimated came in 2024. We got fewer jobs being created because we're seeing deterioration in the labor market. So the Labor Department's doing some really fancy accounting tricks to try to make things look better than they really are. Now, based on the data that we have, in 2023, we saw the economy add nearly 2.6 million jobs. 2,594,000 jobs were created. The data we have for 2024, which again could change slightly, there are still revisions taking place, but what we know right now, in 2024, there was nearly 2 million jobs created, 1.9 million jobs created, 1,996,000 jobs were created. The difference between the two is nearly 600,000. 598,000 fewer jobs were created in 2024 than in 2023. This was above 800,000. Again, we've seen some changes made, but you still have a difference. 598,000 fewer jobs being created in 2024 than 2023. That is a deterioration in the labor market. Eventually, we're going to see negative numbers with job creation, either right before the recession starts or as we go into the recession, one or the other. Let me just say this again. Well, they've overestimated, 151,000, 112,000, 178,000, and these numbers, 119,000, big numbers, some not as big, but as they've greatly overestimated the amount of jobs created, a lot of the jobs that were created 2023 and 2024 were government jobs, artificially propping things up. Starting to come down now Look at the 18-month moving average with a year-over-year percent change. Again, the peak and decline with the growth in government jobs is associated with recessions, and you could see that. And again, here, 18-month moving average is starting to turn down. We've already begun to see it turn down. There are massive amounts of government job creation taking place. And in the decline, they're still creating government jobs, just fewer of them. Is helping artificially prop up the jobs report. This is interesting because the 18-month moving average here with the year-over-year percent, again, this has been associated, when you begin to see this turn down, it's been associated with the coming recession. Here, the self-imposed shutdown of the economy, obviously with the pandemic, but again, it tends to peak right before the recession or during the recession. We had it in the early 90s, peak out right there as the recession was beginning, and then flatten out and begin to drop. We saw it just before recession hit during the stock market putting in the topping process there in 2000. We saw that begin to decline just ahead of the recession, and we saw it peak and turn down during the recession that had already begun in December of 2007. Dramatically dropping as we moved into 2008 and on into 2009. Again, I just find it interesting. The shaded areas are recessions. I just find it very interesting. Now starting to see the 18-month moving average start to move down with the U.S. Government jobs growth has been associated with recessions, which has been associated with the unemployment rate beginning to turn back up. Now, the unemployment rate has already triggered that a recession is about to happen on a recession indicator called the Sahm Rule. It's never been wrong, ever. All the data we have compiled since the 1950s, it has never been wrong. The Sahm Rule indicator is a 3-month moving average of the unemployment rate. And when it moves above the low from the previous 12 months, it triggers the Sahm Rule, meaning that a recession is about to happen. That was triggered in August of 2024, 6 months ago, with the July jobs data. So in August, we have an official signal triggered with the jobs data in August of 2024. Now, it's warning we're about to have a recession. It's never been wrong. I believe the recession indicators. Now, Powell was asked about this in September, right after it was triggered in August, and he dismissed it. But that's what the Fed always does. They always tell us we're not going to have a recession, and then we do. He said in December at the Fed meeting, in his press conference, said it's clear we've avoided a recession. Those words are going to come back to haunt him because we're going to have a recession. I believe the recession indicators over the Fed any day of the week. These are the people that told us there was no housing bubble. These are the people that told us we weren't going to have a recession in 2001 and in 2007. These are the people that told us that inflation was transitory into 2021 and early 2022. Even the creator of the Sahm Rule indicator, Claudia Sahm, she dismisses her own indicator. She's out on financial channels saying it's given a false positive. Now, what that means is that the signal's been triggered, but it's not been correct. A recession did not manifest itself. And she gives reasons about job participation and making excuses that this time it's different. This time it's not going to work. And she's dismissing her own indicator. She's a brilliant economist, but again, the same thing with the folks on the financial channels. They're telling us we're going to have this soft landing, and it's a bunch of nonsense. It's like I talked about, only the elite can see it. And then you get the people on social media, the herd, repeating what all these experts say. And again, every time they try to tell us that we've had a soft landing, none of the recession indicators are triggered. And when they're doing the cycle, it's part of the larger cycle what they're doing it in. Try to tell us we had full employment when we never, or soft landing when we never even reached full employment, when we were still in an economic expansion. But again, it's fantasy land and really arrogance. They want to act like they can micromanage the economy. Talked about that previously. I should talk about these recession indicators, but this one's really important because it's not been wrong. The signal's been triggered in August, 6 months ago, but there's a delay. You got to remember, we've never done what we've done here. Had all this artificial stimulus. Now you've got the artificial stimulus beginning to wear off, but then in 2024 we have this massive, and even in 2023, 2022, we had massive government spending as never seen before. In 2024, we spent nearly $7.5 trillion in 1 year. That's crazy. That artificially propped up the economy. There was $2.2 trillion in government deficit spending in 2024. Over the last 4 years, we've spent in 4 years $8.2 trillion in deficit spending, government deficit spending. That's never been done before. That's a record. We've had all this artificial stimulus with the Fed and with the government. So I think that the signal is not a false positive. Oh, it triggered a false, it's going to happen, but it's not going to not manifest. That's never happened with the signal before. Every single time it's been triggered, a recession has followed. I believe this indicator. To say that it was a false positive in 1959, no, it wasn't. It was a delayed signal. It happened 5 months later in 1959. Triggered before the 1969 recession. It triggered just after it was a short delay for the 1973 recession began in November, and it triggered at the start of the new year in early 1974. 1980, it triggered. 1981, recessions followed immediately. Then in 1990, we had an immediate recession triggered. 2001, 2007, there was a delay. Yet we still had the Great Recession, 2020, with the self-imposed shutdown of the economy. The Sahm Rule triggered simultaneously with the recession. In periods where it's been delayed, like in 2007, like in 1959. We've never seen the amount of artificial stimulus thrown at an economy like we've seen at this one. We've never seen that in history. I don't think it's this false positive. I think it's going to happen. I just think it's a delayed signal. That's all. I think we're about to start a recession. This is why I believe a recession. Plus, with this signal, we have the uninverting of the yield curve between the 10 minus the 2. Recession signals have been triggered long before the election, long before Trump's tariffs. I think the recession's just been delayed because we've had so much government spending artificially propping up the economy. Now that's being removed, with Doge taking a wrecking ball to all the government waste and fraud. Out there now talking about a balanced budget. So I think the reduction in government spending is going to allow the recession to happen. They're going to be triggered by fears of inflation. Fed's still going to cut just like they did in 2007. There are fears of inflation back then. The Fed was worried about inflation, and yet they still did jumbo cuts and slashed rates as inflation continued to go higher. And that's what people don't understand. That happened in 2008 when the recession began in 2007. The Fed panicked shortly after that. I'm trying to make here. Every single time in history Sahm Rule has been triggered, has been associated with a recession, immediately or shortly delayed. In the case of 1973, just immediately after the recession began. This time is different. You know, all the elites and all these so-called experts, they tell us the same thing every time. They tell us, oh, no, this time is different. We're going to have a soft landing. Every time they've told us that, we were still in the economic expansion. It's a joke. And this is the stuff they said in 2007 and 8 there. We're going to have a soft landing. 2000 and 2001. Oh, no, we're going to have a soft landing. This time it's different. Not different. These are all the recessions. This is the Sahm Rule recession indicator. Again, the 3-month moving average. Every single time it triggered a recession since 1959. What happened? A recession occurred. Every single time. No false signals. This is the unemployment rate down here. Look at the unemployment rate every time before we moved into recession. When the Sahm Rule triggered, that a recession was about to happen, well, the unemployment rate got a rounding bottom. Do you see this every single time without fail? What do we have right now? A rounding bottom. The unemployment rate ticked back down, but it's still not at the lows, and the Sahm Rule signal has been triggered. We're going to have the recession. People get arrogant, and these elites get arrogant, like over there at the Fed, and tell us, no, time it's different. I could show you recession indicator after recession indicator that's triggering, warning that something's not right. And that's why, like with the inverting of the yield curve, it's telling us something's wrong with the economy. Very reliable recession indicator there. Uninverted, telling us a recession is about to start within a very short amount of time. Now, I wouldn't bet against this signal. And I would suggest to you it's delayed due to the artificial propping up of the economy just before the election, with the $7.5 trillion being spent, $2.2 trillion in government deficit spending. Another reason why we're going to get another round of inflation ticking up. The Fed is still going to cut. They have to, because we're moving into recession. In 2000. Now, here's our S&P 500 daily chart. I told you on Thursday that we had formed, after filling the gap over here from the tariff sell-off, I told you formed a bearish hanging man. And I told you we are likely going to see a test of the low down here with the tariff sell-off. And again, but I told you the candlestick needed to be confirmed. We formed a rising wedge on the 60-minute chart, and I told you the rising wedge either broke down with the formation there and was back testing, or it would expand and we go up and hit the upper boundary again. We ended up hitting the upper boundary as quickly. Here's that 60-minute chart. I told you again we were either breaking down and back testing, which we closed right at the trend line. A little hard to see right here, but we closed right at that breaking of the trend line. We were either breaking down or back testing, or I told you we are expanding. We would expand the pattern and go up and hit this upper boundary again, and then turn, have that hanging man candlestick. We went up, we ended up hitting the upper boundary, and then broke down, expanding the bearish rising wedge. As I said, the question is, do we take out this low? I don't know. Again, I'm looking at the Fibonacci retracements. We've only so far reached the 50% retracement of this advance over here. So I'm watching this very, very closely. Also watching the CPI gap fill. We're going to get the CPI next week, and we had that CPI gap higher. Going to be watching that as well. But these are the issues that are creating the sell-offs. I think we're going to end up setting up a higher low myself. I think the January low will hold, and then we'll see what happens. If I zoom out, move to my other chart here, you can see, again, we've got VWAP support down here just below the CPI gap in the 78.6 Fibonacci, 58.49. The CPI gap is 58.43. We have this VWAP support here coming in closer to our 61.59 Fibonacci at 61.20 Fibonacci at 59.09. So levels that I'm watching. I think we get a bigger pullback. The question is, do we go beyond this low and get it and maybe try to fill the CPI gap and hit the 78.6 Fibonacci? Or do we try to find support at gap support here with the gap support of the CPI gap higher? Do we find support there around the 59.09 level or just underneath that at gap support? We'll be watching to see how it unfolds. But the hanging man candlestick that I told you about Thursday has now played out, being confirmed. I posted this chart on social media on X, formerly known as Twitter, just absolutely attacked for daring to say that we had a hanging man candlestick, but have now been proven correct, as the hanging man has now been confirmed. Probably still more volatility. I just don't know if we take out this low or not. Very well could. If we do, these are the levels of support that I'm looking at.